You know what nobody's talking about right now? The fact that inflation just did something it hasn't done in over 40 years. And if you're retired or getting close, what I'm about to show you should make your blood run cold. January's CPI report just dropped, and inflation is running at 3%. Now, I know what you're thinking. 3% doesn't sound that bad, right? We've seen worse. But here's what they're not telling you. For retirees living on fixed income, this isn't just another number. This is a slow-motion wealth confiscation that's accelerating. Let me paint you a picture of what's really happening. Social Security just gave retirees a 2.5% cost of living adjustment for 2025. Sounds reasonable until you realize inflation is running at 3%. That means every single month you're losing ground. Your purchasing power is eroding by 0.5% every single month. Compound that over a year, over 5 years, over a decade of retirement, and you're looking at a catastrophic loss of wealth. But it gets worse, because that 3% number, that's the official government figure. And if you're a retiree, your actual inflation rate is much higher. Why? Because the things you spend money on, healthcare, prescription drugs, utilities, food, those are inflating faster than the overall index. A recent survey found that 92% of retirees are worried that inflation is lessening the value of their assets. 92%. That's not fear, that's reality setting in. Now here's where this gets really interesting. While retirees are watching their purchasing power evaporate, there's one group that's been quietly preparing for exactly this scenario. Central banks. In 2024, central banks bought more gold than any year on record. We're talking about the people who print money, the people who set interest rates, the people who supposedly control inflation, and they're loading up on gold like there's no tomorrow. Think about that for a second. The very institutions that tell you inflation is under control, that tell you everything's fine, that tell you to trust the system, they're buying physical gold at a pace we've never seen before. What do they know that you don't? Let me take you back to 1971. That's when Nixon closed the gold window, when the dollar officially became a pure fiat currency backed by nothing but faith in the government. At that time, gold was $35 an ounce. Today, it's over $2,600. That's not gold going up. That's the dollar going down. That's 74 times less purchasing power. And here's the kicker. The pace of devaluation is accelerating. In the 1970s, retirees faced a similar crisis. Inflation was running hot, interest rates were climbing, and fixed income investments were getting destroyed. The retirees who survived that decade with their wealth intact had one thing in common. They owned hard assets. They owned gold. They owned silver. They owned things that couldn't be printed into oblivion by a desperate government. Fast forward to today, and we're seeing the same playbook, but on steroids. The Federal Reserve has printed more money in the last 5 years than in the entire previous history of the United States combined. Think about that. More dollars created in 5 years than in the previous 250 years. And they're telling you inflation is only 3%? That's not just misleading, that's insulting. Here's what's really happening behind the scenes. The COMEX, the major commodities exchange where gold and silver are traded, is showing something extraordinary. The ratio of paper gold to physical gold has never been higher. For every ounce of actual physical gold, there are hundreds of paper claims on that same ounce. It's a game of musical chairs, and when the music stops, most people are going to be left standing. And the music is getting ready to stop. We're seeing stress fractures in the system that haven't been there before. In 2023, we saw 3 major bank failures in a single month. Silicon Valley Bank, Signature Bank, First Republic, gone. These weren't small regional banks. These were institutions with hundreds of billions in assets. And what did the government do? They printed more money to bail them out. More inflation, more devaluation, more theft from savers and retirees. Now, let me show you something that should terrify anyone living on a fixed income. In 1980, when inflation was running at similar levels to what we're seeing now, gold hit $850 an ounce. Adjusted for real inflation, not the government's cooked numbers, but actual purchasing power. That's equivalent to over $10,000 an ounce in today's dollars. We're at $2,600 now. That means gold would need to nearly quadruple just to match its inflation-adjusted 1980 high. But here's where it gets really interesting. In 1980, the U.S. national debt was less than $1 trillion. Today, it's over $36 trillion. In 1980, the Federal Reserve's balance sheet was under $200 billion. Today, it's over $7 trillion. In 1980, we were the world's largest creditor nation. Today, we're the world's largest debtor nation. The fundamentals are exponentially worse than they were in 1980, yet gold is nowhere near its inflation-adjusted high. That's not a warning sign. That's a flashing red alarm. And the smart money knows it. Look at what's happening in the physical gold market. Premiums on physical gold coins and bars are at multi-year highs. Delivery times are stretching out. Dealers are struggling to keep inventory. This isn't speculation. This is people who understand what's coming, moving their wealth into something that can't be printed, can't be devalued, and can't be confiscated with the stroke of a pen. Now, I want to talk about something that most financial advisors won't tell you, because frankly, they don't make money if you figure this out. If you're sitting on $100,000 or more in a traditional retirement account, a 401k, an IRA, a TSP, you have options that most people don't know exist. You can move that money into physical gold without triggering taxes or penalties. It's called a gold IRA, and it's one of the most powerful wealth preservation tools available to retirees right now. I put together a free guide that walks through exactly how this works, what the rules are, and how to do it properly. It's in the description below. No sales pitch, just information. Because if you're watching your retirement savings get eaten alive by inflation, you deserve to know all your options. All right, back to what's happening in the markets right now. Because while retirees are getting squeezed, there's a much bigger story unfolding. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create an alternative to the dollar-based financial system. And at the center of that alternative system, gold. China has been buying gold every single month for over 2 years straight. Russia converted a massive portion of its reserves to gold before the Ukraine conflict. India is accumulating gold at levels we haven't seen in decades. These aren't small players. These are some of the largest economies in the world, and they're all moving in the same direction, away from dollars, toward gold. Now, why does this matter for American retirees? Because the dollar's status as the world reserve currency is the only thing that's allowed the U.S. to run massive deficits without immediate consequences. It's allowed us to print trillions of dollars without hyperinflation. It's allowed us to maintain a standard of living that our actual economic productivity doesn't support. And that privilege is ending. When the dollar loses its reserve status, and it's not a question of if, it's a question of when, the inflation that retirees are experiencing now will look like a pleasant memory. We're talking about a potential revaluation of the dollar that could cut purchasing power in half or more in a very short period of time. And if your wealth is sitting in dollar-denominated assets, in bonds, in cash, in money market funds, you're going to watch it evaporate. Let me give you a specific example of how this plays out. In 2008, during the financial crisis, the Federal Reserve dropped interest rates to zero and started printing money through quantitative easing. Gold was around $800 an ounce. By 2011, just 3 years later, gold hit $1,900. That's a 137% increase. And that was with the dollar still firmly entrenched as the world reserve currency. Imagine what happens when that status is actually threatened. But here's what most people miss about that 2008 to 2011 run. It wasn't just about the price going up. It was about preservation. If you had $100,000 in cash in 2008, by 2011, the purchasing power of that cash had been significantly eroded by inflation and money printing. But if you had $100,000 in gold in 2008, by 2011, you had $237,000. You didn't just preserve your wealth, you grew it while everyone else was losing ground. And we're setting up for an even bigger move now. The fundamentals are worse. The debt is higher. The money printing is more extreme. The geopolitical tensions are more severe. And gold is telling you something. It's been making new all-time highs while most people aren't even paying attention. That's not random. That's the market pricing in what's coming. Now, let's talk about silver for a moment, because this is where things get really explosive. Silver is trading around $30 an ounce right now. In 1980, silver hit $50 an ounce. Adjusted for inflation, that's over $180 in today's dollars. Silver is trading at a fraction of its inflation-adjusted high, while industrial demand for silver is at all-time highs. Solar panels, electric vehicles, electronics, medical applications, silver is being consumed at a rate that far exceeds new mining production. And here's the kicker. The above-ground stockpiles of silver are being depleted. For decades, we've been mining silver and using it in industrial applications where it's not economically recoverable. It's gone, used up. And now, with the green energy transition accelerating, demand is spiking while supply is constrained. The silver market is smaller than the gold market, which means when it moves violently. We're talking about potential gains that could dwarf what we see in gold. But let's bring this back to retirees, because that's who's really at risk here. If you retired in 2020 with $1 million in savings and you're living on a 4% withdrawal rate, you're pulling out $40,000 a year. Sounds reasonable, right? But with 3% inflation, your purchasing power is declining every single year. By year 10, that $40,000 only buys what $30,000 bought when you retired. By year 20, it's down to $22,000. You're living on half your original standard of living, and that's assuming inflation stays at 3%. If it spikes higher, which history suggests it will, the decline is even more dramatic. Now, contrast that with someone who moved a portion of their retirement savings into gold in 2020. Gold was around $1,800 an ounce then. Today, it's over $20,600. That's a 44% gain, which not only offset inflation, but provided real growth. And we're just getting started. The factors driving gold higher, money printing, debt accumulation, geopolitical instability, de-dollarization, those aren't going away. They're accelerating. Here's something else that should concern every retiree: the government's response to the next crisis. Because there will be another crisis. There always is. And when it comes, the government will do what it always does: print money. Lots of it. They'll call it stimulus, or relief, or whatever politically palatable term is in fashion. But what it really is inflation. It's a transfer of wealth from savers to debtors, from retirees on fixed income to the government that's drowning in debt. And you know what they can't print? Gold. They can't create it out of thin air. They can't devalue it with a policy decision. They can't inflate it away. That's why it's been money for 5,000 years. That's why central banks hold it. That's why the smart money is accumulating it right now. Let me tell you about something that happened in Cyprus in 2013. The banks were failing and the government needed money. So they did something unprecedented. They confiscated deposits directly from bank accounts. If you had more than 100,000 euros in a Cypriot bank, the government just took a portion of it. Gone. No warning. No recourse. They called it a bail-in. And it set a precedent that's now part of the international banking framework. Now, I'm not saying that's going to happen in the United States tomorrow, but I am saying that when governments get desperate, they do desperate things. And the U.S. government is $36 trillion in debt with no plan to pay it back. Social Security is projected to be insolvent by 2033. Medicare is in even worse shape. The math doesn't work. Something has to give. And when it does, the people who will pay the price are the ones who can't fight back, retirees living on fixed income. That's why this red alert on inflation isn't just about the current 3% rate. It's about what that rate represents. It's about the trajectory we're on. It's about the end game of a monetary system that's been running on borrowed time for over 50 years. And it's about the window of opportunity that's still open right now to protect yourself before that window slams shut. Because here's the thing about gold and silver. They're not investments in the traditional sense. They're insurance. They're the fire extinguisher you hope you never need but are damn glad you have when the house is burning down. And right now, there's smoke coming from every corner of the financial system. The bond market is flashing warning signs. The stock market is trading at valuations that have only been seen twice before, right before the 1929 crash and right before the 2000 dot-com bubble. The real estate market is showing stress fractures, and inflation is eating away at the foundation of retirement security for millions of Americans. So what do? First, you educate yourself. You understand what's happening and why. You look at the data, not the headlines. You follow the actions of central banks, not their words. You watch what the smart money is doing, not what the talking heads on TV are saying. Second, you take action. You don't need to go all in on gold and silver, but you need to have some. Financial advisors traditionally recommend 5 to 10% of your portfolio in precious metals. Given where we are in the cycle, given the risks we're facing, I'd argue that's too conservative. But even if you start with 10%, that's a meaningful hedge against what's coming. And third, you do it now, not next month, not after the next Fed meeting, not when gold hits some arbitrary price target. Now. Because the thing about insurance is, you can't buy it after the house is on fire. You can't buy flood insurance after the hurricane hits, and you can't protect your wealth from inflation after the currency collapse begins. The retirees who are going to make it through what's coming are the ones who see the warning signs and act on them. The ones who understand that the rules of the game have changed. The ones who recognize that a 2.5% Social Security increase against 3%. Inflation isn't just a minor inconvenience. It's a systematic transfer of wealth that will compound into a retirement crisis. This isn't fear-mongering. This is pattern recognition. This is looking at history and understanding that what's happened before will happen again. The Roman Empire debased its currency and collapsed. The Weimar Republic printed money and destroyed its middle class. Zimbabwe printed money and created hyperinflation. Venezuela printed money and created poverty. And the United States is printing money at a pace that makes all of those examples look tame. The red alert isn't coming. It's already here. The question is whether you're going to heed it or ignore it, whether you're going to take action or hope for the best, whether you're going to protect the wealth you've spent a lifetime building or watch it slowly erode away while you tell yourself everything's fine. Because I can promise you this, 5 years from now, 10 years from now, you're going to look back at this moment and either be grateful you acted or regretful you didn't. The retirees who own gold and silver are going to be the ones who maintained their standard of living, the ones who can still afford their medications, their utilities, their groceries, the ones who aren't forced to choose between heating their home and eating properly. This is your moment. This is your warning. The data is clear. The trend is obvious. The outcome is predictable. What you do with that information is up to you, but don't say you weren't warned. Don't say you didn't see it coming. Because the red alert is flashing right now and the clock is ticking.